If they get $10,000 a month in cash flow, then they can leave their job. Remember, that was the gold standard back in 2013, 2014, 2015 when I was getting started. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to video, I'm going to be discussing what is PPU, which we refer to as profit per unit, and other important metrics in multifamily. So if you want to learn about the important metrics that you should be following, or at least really discussing or even thinking about or measuring in your portfolio, listen on. But before I start, I want you to subscribe to the Jake and Gino channel on our YouTube page, because every week we release premium content. We have our Monday masterclasses every Monday with the Jake and Gino community. If you subscribe to the YouTube page, you will be getting these recordings. They're hour-long lessons that we have with our students. We typically bring on experts such as cost segregation experts, syndication attorney experts, experts in the multifamily. It's behind the curtain, and students ask us questions as well. So if you want that premium content, what I want you to do is subscribe to the channel. Now, what is PPU? Very few people have even heard of the acronym, and even less actually use it. I would love it if you had a chance in the next few days to go to the Jake and Gino channel, and on our podcast, look up Frank Gallinelli. Now, Frank Gallinelli has been doing multifamily, and he's been teaching it for years. He's probably in his late 70s. He's one of the original guys who put out content, and his books, for me early on, completely changed the way I looked at real estate. It was really numbers driven. He talked about cap rates, cash on cash, debt coverage ratios, loss to lease, all of the formulas. I really learned a lot of stuff with Frank Gallinelli, and he was on our podcast, and we mentioned PPU, which is profit per unit. And he was a little, I don't want to say taken back, but he was like, wow, I never really utilized that metric. And for Jake and myself, it has become the standard by which we look at our portfolio. For us, it's really important. We're not just looking at the size of our portfolio and how many doors we have under management. We don't really care about that anymore. Not that we ever did. It was more of what and how profitable is our portfolio. Great, you own 1,000 doors. You're making, $10,000 on those 1,000 doors. Big deal. To me, at least. I'd rather have less doors, but have them be more profitable. And to some people, they're saying, you know what? I want more doors. I can have more fees. When all of a sudden market starts elevating, I have profits spread along many more units. And that makes great sense. That's an excellent way to look at it, especially if you're syndicating. But for us, we're vertically integrated. We need to manage our portfolio. We can't outgrow our infrastructure. So profit per unit for us is just like the gold standard. Now, what's the formula? It's real simple. You take your profit and you divide it by the number of units you have. So let's say, for instance, you have $10,000 in profit this month. Your cash flow after all expenses, after debt, after operating expenses, after CapEx is $10,000. And you have 100 units. So you have $10,000 divided by 100 units. That's $100 per unit in profit. Now, I remember when I started out, that was the gold standard. That's what everyone wanted to hit. They wanted to get $100 per door. So if they have 100 doors in their portfolio, 100 times 100, that means they're getting $10,000 a month in cash flow. If they get $10,000 a month in cash flow, then they can leave their job. Remember, that was the gold standard back in 2013, 2014, 2015 when I was getting started. Now, the interesting thing with profit per unit, it really is dependent upon so many different variables. The first thing is it's the market. If you're in a market, let's say like New York, or a market that is really high, rents, you're going to get a higher profit per unit, or at least you should, but you're going to have a lot less units. A unit in New York can cost you $1 million for a unit. In Knoxville, if you're buying $100,000 per unit, you may have 10 units. So you can see it really depends upon the market and what you're looking for. For us, in our market of East Tennessee, right now, we're around, in our portfolio, this past month was $242 in profit per unit. Last month, it was $331 in profit per unit. Now, another thing to take into consideration is, as you're assessing your entire portfolio, are you putting in units there that you're repositioning, that you've just taken over? That will dilute the profit per unit, but it really depends upon what you'd want to do. What I would say is, if you have 100 units and you've got 80 that are performing, and you just took over 20 that aren't performing, that you just started and you need to reposition, and they're not going to be profitable in the next 6 to 12 months, then what you do is do one for the 80 units, see what that profit per unit is, and do one for the entire portfolio. And what's really cool is when those 820 units are absorbed into the 80 and they start performing, you'll see the difference. So try to set a metric of what you're trying to hit. We try to hit $200 in profit per unit every month on our stabilized portfolio. And it's worked out really well and we've done better. When I'm looking at that number for us, it really is dependent upon how well and operationally are you running your portfolio. It really makes you focus on expenses, but also on top line growth, on revenue. Where is your revenue? And then obviously you can't be over levered in real estate. And if you are, it's going to hurt your profit per unit. So when we're looking at a deal and analyzing a deal for the future, and we're doing our pro forma, we're looking to hit at least $200 in profit per unit once that asset is stabilized. It may not be there day one, but hopefully day 90, day 180, day 360, it will be there. Now, let's look at another one. And this next one that I love to talk about is another one. I hate using this word gold standard. I've been using it a lot in this podcast. But for us, when we started out back in 2011, it seems like 100 years ago, cash on cash return was just bantered around everywhere. And it's one of those things where I think as syndication came along and people started raising money for deals, they were looking more for exits. They weren't looking as real estate, when you're looking at it from our lens as a business, as future, cash flows. I mean, you are, but you're not looking at it as like you're running a business. What you're doing is you're buying these assets, and within 2 to 3 years, you're flipping them out, and you're looking for the metric IRR. I don't want to talk about internal rate of return here. I want to talk about what cash on cash is, because for us, if you're a buy and hold investor, I don't really think you care about internal rate of return. I think you care about what your cash flowing, what your cash on cash is, and what your profit per unit is. A lot of syndicators aren't going to be using profit per unit because they're not going to be holding the asset long enough. And if they are, hopefully they'll buy the asset, they'll reposition it, and instead of selling it, maybe they'll refinance it, pull some equity out, distribute it, and continue to hold it. And then that profit per unit becomes really relevant because now you've got an asset that's stabilized, it's going back, your money's been distributed, and now you're going forward. A cash on cash, very simple. How much cash you have invested in this deal divided by the value of the deal. So if you have $100,000 of cash in a deal and it's $1 million, $100,000 profit, $1 million, 100,000 divided by a million is 10%. We're always looking for at least a 10% cash on cash return ourselves once this deal has been repositioned. When we started, this is where the market cycle was, and I think the market cycle may return back to this metric. We were getting deals day one, cash on cash with 10%. And you may be saying to yourself, well, how was it like that back then? The sentiment was a lot different, and rents were so much lower, but prices per unit were so much lower, and there wasn't that much money in the economy going to multifamily. It was really a buyer's market. And you're seeing when there's a buyer's market, these metrics are going to be much more favorable to you, whether it's profit per unit. You're going to have a higher profit per unit going in and being able to buy these assets, and also this cash on cash. Now, you may say to yourself, when I'm buying these assets day one, there's very little cash on cash return. Do your pro forma and figure out what it can be in your market. There may be some markets where you get very little, if no, cash on cash once the asset's repositioned. A lot of that happens in really high flying markets, like markets in California and markets in New York and markets in South Florida. You're not investing for profit per unit there, and you're not investing for cash flow or cash on cash there. You're investing for equity. So understand the market. And if you're in a market that you'd like the cash flow, use the cash on cash return. So a couple more metrics that we like to talk about. And then the next one is debt coverage ratio. Debt coverage ratio simply is your net operating income divided by the annual debt. Now, banks want a 1.25 debt coverage ratio. What that means is you have a 25% more income coming in than what you have debt. You're able to service the debt. If you have a 1.00 debt coverage ratio, it means you just have enough income to service the debt. You have nothing left over to pay for bills. You have no profit left over. And it's very interesting because 2 and 3 years ago, when these deals that were stabilized were being bought on bridge debt, it's because the debt coverage ratio was nowhere near 1.25. So they had to become creative and hit this and a debt service coverage ratio of 1.25. So be wary of that. That's the number that most banks are looking for, and that's something that you want to be looking for. And it's something where, be careful. If you're buying a deal that's not stabilized, you're going to be using bridge debt. You're going to have to reposition it to at least a 1.25, if not a 1.3. Now that's very important. Now this last metric that we're going to be talking about is what we call the third rail of multifamily. Everyone has an opinion on this metric. And what is this metric? It's a cap rate. Now, very simple. Cap rate formula is your net operating income divided by the value. So if your net operating income, for instance, is $100,000 and your value or where you're buying the property, what the property price is or what you bought it at is $1 million. Simply, you take $100,000 divided by $1 million and you get a 0.1 or a 10 cap. Now, interesting about cap rates, they really are important because you're basing your purchasing on a cap rate in a specific market. That's the crazy part. People don't understand, well, I'm not buying on a cap rate. Well, you're sort of buying on a cap rate and you sort of are refinancing on a cap rate. Now, the crazy thing about cap rates is there's no debt. So when you're getting that analysis, there's no debt in there. You're just taking it based on your net NOI and the value. What you're trying to do is you're trying to compare apples to apples, right? Because once you start putting debt on, things start changing. So in that scenario, you have a 10 cap. If you just look at it this way and nothing happens to the property, in essence, what you're saying to yourself, if I hold this property for 10 years at a 10 cap, I'm going to get my entire money back. So that's one way of looking at it. What you're trying to do as an investor, and it's interesting because if you're a value investor, you're buying a property that is really suppressed. NOI is low on the property, right? So your NOI may be $50,000 instead of $100,000. So if you're dividing 50,000 by a million, you're seeing where it is. You're at a 5 cap instead of 100,000 divided by a million. So right then and there, cap rates really don't apply when you're buying a value add. You just need to understand if you're buying at a 50,000, can you get your NOI to 100,000 or 150,000? What you're trying to do is you're trying to buy it at a certain cap rate where the market is, and you're trying to get it above. You're trying to push that NOI to above the cap rate. So if you're buying a property with a cap rate of 5 and the market is a 5 cap, your hopes as a value investor is to increase that cap rate to an 8 or 9 and then put it on the market to sell at a 5, and you're going to get that value between the 5 and the 8 cap, or to refinance that value out and to continue to hold it. Now, we've got other recordings on our how-to and on the Jake and Gino podcast if you want to learn more about cap rates. It is an important metric, but it's not something that we look at when we're buying. Because we're buying these assets that are suppressed. You're buying properties that have lower net operating income, so obviously the cap rates are going to be lower. And if you look historically, in 2008, cap rates started decompressing as you go into a recession. And that's what's been happening here in 2022. Cap rates had hit a low and they're starting to decompress. They went from, on average, I think around a 5 cap in the entire market of the United States, and they're decompressing to a 5.1, 5.2. I'm not exactly sure where they are right now nationwide, but cap rates have an inverse relationship. As your cap rates drop, your values increase. And there's one more thing that I like to say about cap rates before I leave the third rail of real estate. Cap rates, I've heard a lot of beginning investors say, I want high cap rates. That's all I'm looking for. And with the higher cap rates, you are going to cash flow more. But why are cap rates higher, let's say in markets that are smaller and markets that have less population and less job growth, than let's say markets that are hotter, such as let's say Nashville or Charlotte? Cap rates that are higher in those markets, they denote more risk. Because remember, when you're buying real estate, you're buying a future stream of revenue. Are you more likely to collect that revenue and have more job growth and less risk in a market that is growing, or in a market that's more stagnant and losing population? Yes. So therefore, in a market like Charlotte or Nashville, you're going to be paying a higher price because you're foreseeing as an investor, and the institutions are, in the future, that there's going to be less risk to be able to collect that revenue. As an example, a smaller market, a tertiary market, a market that has population loss or job loss, there's going to be more risk there. So they're willing to pay less for that asset, which makes the cap rate higher. So don't make your metrics or your buying decisions just on one metric. Try to pick a couple that you're trying to accomplish. If you're looking for capital appreciation or value add, maybe you do look at cap rates. You're trying to buy cap rates and you're trying to see if you can find a property that has substantial value add. And if you're in a lower cap rate market, the more you add value to a lower cap rate market, the more bang for your buck that you're going to get. So there is no one size fits all. I'm not going to come here and say to you, hey, focus just on cash on cash. You need 10%. Look at a debt cover ratio of 1.25. Look at an NO at a cap rate of a 4 cap. Look at a PPU of $200 profit per unit. It's up to you to make those decisions. And I'll leave you with this. That's what we call your buy box. That's why at Jake and Gino, we call it buy right, manage right, and finance right. And if you've listened this long, what I want you to do is to email me, gino@jakeandgino.com, and I'll send you out a free PDF copy of our Wheelbarrow Profits book, because it talks about the buy right, the manage right, and the finance right. And what's interesting is I've been talking about buy right this entire time. And as you're having these formulations and all of these formulas, you're listening to them. What is your buy right? We know what we're looking for as far as debt coverage ratios, as far as cap rates, as far as our cash on cash, as far as our profit per unit. Now it's up to you to start crystallizing that and understand what you're trying to accomplish in 2025 and beyond. I want to thank you for spending part of your time with me on this how-to, and I will see you on next week's how-to. Thanks, everyone. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.